Welcome to today's finance series. I am Oyekemi Ajayi. It's always a great pleasure to share one or two insights with respect to a particular finance topic in the course of the week. Today, I am going to be talking about debt capital and what lenders typically look out for before issuing a facility to a company. Follow me as we go into this round of presentation. Thank you. So businesses have financial needs, and these needs may be in form of working capital requirements, or maybe the need for expansion, the need to replace a particular equipment or the other, and they need to fund this need. Now, this can be done using debt capital. Now, you can raise debt on the capital market in form of bonds, in form of commercial papers. You can even obtain a loan or facility from a financial institution. Today, we're going to be looking at those things that a typical lender, a lender can be a bank, it can be a DFI, it can be, borrowers within the capital market, depending on the nature of the form of debt capital that you are looking to adopt. So today, we're going to be looking at the key things that a lender would look at before granting you a facility in your organization. Before I go into that, I just want to quickly state the difference between loan and debt. Now, in a lot of instances, loan and debt are terms that are used interchangeably because both of them actually relate to borrowing. However, there's a slight difference or a thin line between both. Loan is the money borrowed from a lender, while debt is the money that is raised through the issuance of bonds or debentures. Now, the key thing is both of them are borrowed from lenders, yes. You are required to pay interest and to pay your principal on both. However, where you get them from or the source in which you get them from is a differentiating factor. Now, let's look at what a lender would consider before issuing a facility to an organization. The very first is your credit history and the credit rating of the applicant. So one of the things they will look out for is, do you have previous debts with other institutions? How have you been servicing this debt on a periodic basis? Have you been defaulting? Have you been paying as at when due? The next they will look at is your cash flows. The next they would also look at is the collateral and the extent to which your collateral can cover. So lenders typically want to minimize their own risk, hence the demand for collateral for a secured loan. So one of the things we advise is that your collateral must be able to cover your loan at least 1.2 times or 1.5 times to ensure that there is proper cover. Please note that short-term assets such as receivables and inventories will not be accepted as a form of security for a long-term facility. Taking it a step further, we're going to be looking at the repayment capacity of the borrower. In simple terms, we are saying what is the borrower's ability to pay back this loan within the required time frame. Other things we would look at would be the financial statements. One will be looking at the income statement to see the performance of the business, the balance sheets to see the financial position of the business, and then the cash flows to be able to even determine repayment. Remember, cash flows is what is used to repay your debts. Other things they would require will be normal KYC requirements like certificate of incorporation, utility bills, proof of identification, your tax identification numbers, maybe your driver's license or means of international passports and all that. For SMEs or mid-sized businesses, the bank would also ask for the personal guarantee of the owner of the business. And then finally, we'll be looking at the project itself. General information about the projects or what you intend to fund or finance. We'd also be looking at the viability, the profitability, the impact of this project. I mean, if you carry out a project and a bank has to finance it, would you create new employment opportunities? Would your project be beneficial to the environment? That's where we talk about your ESG. We'd also be looking at the operating costs of that project. The lender too would also want to see if that project is profitable, what are the technical requirements of the project, and a lot of things with respect to evaluation of the project. All that has been mentioned are basic requirements that a lender will typically look out for before granting a facility. But you must have at the back of your mind that if you are dealing with a DFI or other institutions, a lot of them have more specific requirements. So you need to take all this into consideration when you are applying for a facility. Thank you so much for listening. Thank you for your time. I hope this has been worth the time. Do have a great one.